Today, we look again at defensive investment, given how topical that almost certainly is at the moment. So hello and welcome back to our channel. In our last video, I spent some time looking at the fact that a big stock market crash could very well be on its way at some point reasonably soon, and at many of the reasons lots of market commentators are talking about this at the moment. The key point I made in that video, however, was that you can learn how to invest so that crashes don't matter. And as I said, it is really important to be wary of the possibility of a massive financial market crash, but in the main, so that you can ensure that you're confident in your long-run investment plan and continue to do the right thing all the way through any crash and beyond. The reason that most investors make returns which are far lower than market returns and or even lose money is because they don't have such a plan and because they tend to panic and sell at a loss when the market crashes. It's really important to make sure that you don't suffer this fate if you want to maximize your chances of building real wealth over a lifetime of investment. And to help you with this, in my video series entitled How to Invest So That Crashes Don't Matter, I highlighted 4 key approaches to investment. And because repetition is the mother of learning, as the old saying goes, or repetitio mater studiorum est, in the original very pretentious Latin, as a reminder, these are: firstly, to invest for the long run and ideally the very long run. Secondly, to invest regularly and hopefully automate your investment, ideally by direct debit. Thirdly, as we've covered many times, to completely ignore the news as you go along with that. And this is what will help you avoid the fate so many people suffer when there is a crash. And fourthly, to get your mix of assets roughly right based on your age and stage. So one of the key things you're going to want to get right when you arrange your financial affairs is to trade off risk versus reward, more or less obviously. And the key feature of investing in financial markets is that assets which might provide you with a higher percentage return tend to be riskier and have the potential to lose you lots of money in a crash, assuming you panic and sell out, of course. And at the other end of the investment spectrum, things that are inherently safer will tend to give you lower investment returns, although gold has been doing a pretty good job at disproving that idea in recent years. But I digress. One of the key ways to deal with this trade-off between higher return, higher risk assets and lower return, lower risk assets, big picture, and how you can also ensure that you're in good shape if a big crash comes, is to do your best to get the right blend of these things over time. And I've covered how to do this throughout this video series, and most particularly when we looked at something called 100 minus your age. For some decades now, many financial advisors and smart investors have used a basic rule of thumb that says that the percentage you might invest in risky, aggressive assets such as equities or shares or the stock market should be 100 minus your age, with the rest being held in lower risk or defensive stuff. If you're 30, you might invest roughly 70% of what you can afford each month into higher return investments such as shares, and around 30% in more defensive stuff. And if you're 70, you might have only 30% of your pot in riskier higher return assets and 70% in lower risk assets. Traditionally, this approach used equities or shares for the riskier proportion of your investments and bonds for the lower risk bit. And in another of my previous videos, we focused on the idea that all you might need to do when it comes to the aggressive investments here is to choose to invest in a large stock market of some kind. So that might be the S&P 500, the MSCI World, or the FTSE All World. Please do check out our video on that subject if you want a reminder about all of that. As I've also explained before in this video series, the defensive bit is a good deal trickier than that aggressive bit nowadays, and at least it certainly has been in recent years. And this is because real interest rates, so that's interest rates after inflation, have been very low or even negative for a long time. As I explained in the video where we first introduced the idea of 100 minus your age, traditionally the defensive bit of someone's 100 minus your age portfolio would have been allocated to bonds, as I've said. In recent years, this would have been highly problematic because interest rates and bond returns have been very low for most of the time since the financial crisis in 2007. And in fact, in the UK, real interest rates after inflation have even been negative for a fair bit of the last decade or more. Arguably even more important in the last few years, however, As interest rates have risen, this has caused the price of many bonds and bond funds to fall a long way, because bond prices fall when interest rates rise. This has been hugely damaging to plenty of portfolios, and particularly to many British pension funds, which have been increasingly pushed into buying bonds by ill-considered government policy in recent decades. And this has also negatively impacted something called target date or life strategy funds, which you may have heard of because of their allocation to bonds too. So given all of this, bonds have often proven to be a pretty poor place to have your defensive investment capital. And this has meant that the defensive bit of your portfolio could quite possibly have been losing you money in real terms for some time. Not ideal, and particularly if you're a bit older and might have a big chunk of your money that you want to invest defensively based on that idea of 100 minus your age. And because of all of this, today I wanted to take a bit of time again to explain how this is one of the key reasons that as long ago as 10 years ago, my team and I set out on the long road to build and launch our own investment fund, the snappily named VTPEF Global Multi-Asset Fund. And I wanted to explain a bit more about what it is and what it isn't, and the extent to which we think it does what it says on the tin. And before I explain in a bit more detail about our fund, there are a few important points to make first. So first, because I will be explicitly talking about our fund, this video must be considered to be a financial promotion according to the strict rules that exist around such things, and it is disclaimed as such. We obviously have a high level of commercial self-interest in highlighting our fund as an option here. But next, for the more cynical folk in our audience who might find it off-putting that I'm talking about our own investment fund today, I wanted to say a couple of other things here. First, that I hope you'll notice that this is only our second video in nearly 2 years of posting free educational videos for you on YouTube, where we've done anything in any way salesy or commercial about our fund. And secondly, the broad point I'm making about our fund in this video is that we would like to think it could be a solid potential option for the defensive proportion of someone's 100 minus your age approach to investment, or for anyone who is particularly risk averse, who's very focused on protecting against the risk of loss as they approach retirement perhaps. By making this point, and if you follow that broad idea of 100 minus your age, what this means is that I'm suggesting that a 30-year-old, for example, might have fully 70% of their money not in our fund, and instead in the more aggressive stock market investments we've covered in previous videos. A 40-year-old might have 60% not in our fund. I hope that you might agree that this is a pretty rare approach for a fund management company to take. Our whole approach, big picture, is around using the right mix of aggressive and defensive investments to seek to get a great risk-adjusted return over many years of investment and help protect you against catastrophic loss. This is the holy grail of investment. I've shared many hours of video to explain this approach in the last 2 years because I really believe that it works. And it can give you real peace of mind once you understand all of this stuff too. So this all having been said, today I did want to explain how our fund seeks to do a solid job, particularly when it comes to the defensive element of what you might want to do over many years of investment. And for what it's worth, I would also hope that the ideas in the rest of this video should be of general interest, whether or not you would like to have a look at our fund, by the way. So first and foremost, our fund seeks to protect against significant loss. And to do this, it uses 2 key investment techniques, both of which I would argue are pretty interesting in their own right. And these are, first, what we call true diversification, and secondly, something called formula-based trend following. So to get into each of these in turn. As a reminder, diversification is just the finance industry's word for spreading your risk around many investments, of not having all your eggs in one basket, if you like. And true diversification is doing this by asset class and by geography. So our fund looks to own a broad range of investments from all over the world and across all of the main asset classes. And these are all a matter of record because we share them transparently, by the way. This compares to many funds which tend to focus only on one asset class, such as just shares or just bonds, for example, or on only one country or region, such as just the UK or just the US. Many of the smartest and wealthiest investors in history have shown how effective owning all asset classes in all major regions of the world can be. And this is because those main asset classes, shares, bonds, cash, property, and commodities, respond differently to various stages of an economic cycle. So growth, deflation, inflation, stagnation, and so on. And this is why we believe that a good approach is to look to own most major assets in most major regions of the world, otherwise known as true diversification. And as you may know by now, I call this owning the world, and this was the subject of my first personal finance book. Anyone who's followed me for any length of time will be familiar with these ideas already. So many of the wealthiest and most financially literate people in the world have invested like this for some way more than a century. And this includes the endowment funds of places like Oxford and Cambridge and Harvard and Yale too. It should intuitively make sense to you why this might work. So for example, from 2007 to 2009, many stock markets all over the world more than halved. But oil hit an all-time high in 2008, and gold went up more than 23% in 2009, priced in dollars. Sometimes Asia is great and Europe stagnates, and sometimes America is the place to be. The easiest thing to do is just do your best to have exposure to most areas of the world and to the main asset classes. And you might think that this approach will mean you end up with indifferent performance, but the evidence of history is that this is not the case over long enough periods of time at least. In the early 1980s, leading US investment writer Harry Browne said about this approach that over broad periods of time, the winning investments add more value to the portfolio than the losing investments take away. And Jack Meyer, who used to run the multi-billion-dollar Harvard University Endowment Fund and who achieved an average return of 15.9% a year under his tenure, so that's 910% compounded, has said that the most powerful tool an investor has working for him or her is diversification. And true diversification allows you to build portfolios with higher returns for the same risk. Most investors are far less diversified than they should be. This is why our fund owns a wide range of assets from all over the world. And our second main investment technique is known as formula-based trend following. To explain, looking at financial data as far back as practically possible, and we've gone all the way back to 1872 for what it's worth, and across essentially all markets, academic research and real experience has shown that the positive or negative direction of any financial market is statistically more likely to continue than to reverse. And that might seem a little complicated and also a little strange, but it's actually a simple function of human nature. If a financial market has been going up steadily, then all other things being equal, there's a good chance it will continue to do so, if only because of the herd mentality of human beings. And American shares have given us a great example of this for quite a few years now, as we've covered in many of our previous videos. Trends are well known and reasonably well understood and have been driving boom and bust cycles for centuries. As a result, over very long periods of time, academics looking at financial markets have worked out a number of methods for estimating where prices in a market will likely go based on where they have come from. And this broad approach to investment is known as technical analysis. And it can generate strict rules which help investors buy and sell with a higher probability of success. And arguably one of the most effective of such techniques is called trend following. Trend following simply takes a current price of an asset and compares it to a historical average price. So if the current price is above the chosen historical average price, then the investor remains invested in that asset. If the current price falls below the relevant historical average, then the investor sells out of that asset and switches those funds into cash or something similarly defensive to protect against further falls. The important idea here is that if an asset starts falling, at a certain point, a trend following strategy will switch out of that asset and into cash to protect against the price falling still further. Preserving capital this way is extremely important for all the reasons we've looked at in this video series, and particularly as you approach retirement. The level at which such a strategy will sell out of an asset will be based on a strict, disciplined, consistent, and rules-based process. And equally, when the price of an asset starts to rise again, this strategy will look to buy back in. This broad approach is proven in practice and tested over more than a century with different assets and in different countries, and it can have a significant effect on protecting against big falls in all markets and on improving returns over long enough periods of time, given the crucial importance of preserving capital. And this is precisely what our fund seeks to do. It's worth highlighting that the price such a strategy can pay for this downside protection can be relatively long periods where the strategy may not do very much. It's very important to note that our fund is very much an investment tortoise rather than an investment hare. The fund tries, above all else, to avoid ever suffering a massive fall, with the result that you might then sell out of your position in panic, or at the very least would then need to make huge returns to get back to square one because of the way the maths work. Remember, a 100% return is needed to recover a 50% loss, something called the break-even fallacy, which I've explained before. In many ways, our fund strategy is more like a savings plan than many more conventional funds. If you save and invest a certain amount every month without fail, you will build a significant sum over time, even at times where the fund might go nowhere, just as you would by saving money in a conventional savings account. The difference is, of course, that in the event that there is a long and durable upward trend, which happens every few years based on more than a century of evidence, you will then be making returns on all of that capital, meaning that your long-run result could be somewhere ahead of what you might have achieved in a cash ISA, current account, mattress, or bond fund. So here I'm showing a chart from our detailed fund overview document, which shows what could have happened to the real-world performance of someone, starting with a £10,000 investment pot in January 2001, which is the beginning of the backtested period we show in that document, and adding £500 each month to their stocks and shares ISA or pension account. And by the end of September 2025, just gone, that person could have over £317,500 in their investment accounts. Note that this person would have invested £158,500 over 24 years and 9 months, and could have ended up with that more than £317,500. And that is to say that fully £159,000 of the money at the period end has come from investment performance. This is the power of compounding over time with low volatility, although it is important to stress that past performance is not an indication of future performance, and this is purely for the purposes of illustration. If you want to own a wide selection of assets in one place and avoid the stress and administrative hassle of figuring out how to do that, you may find our fund a good option, particularly for the defensive proportion of your portfolio, or if you are particularly risk averse or perhaps nearing retirement. We cover all of these points in real detail in our fund overview document and a great deal more besides, and I've provided a link to that document in the description and comments below. For what it's worth, I happen to think that our fund overview document is a great educational piece about investment in its own right, as well as the key marketing document for our fund. So it's important to stress that past performance is not an indication of future performance, but in the several years since we launched the fund, it has significantly outperformed many bonds and bond funds and UK gilts, which many British investors would use as a defensive investment, and by a long way. Anyone using the idea of 100 minus your age and then investing in a big stock market and our fund in the right proportions would have had a pretty good result over time overall, particularly on a risk-adjusted basis. Big picture, this combination of aggressive and defensive investments based on your age has a good chance of capturing upside and of protecting your downside over long periods of time. And I'd also suggest that this approach can give you real peace of mind along the way, because you're getting the mix of assets roughly right based on your age, and you have a good amount of defensive stuff too. The impact of a large stock market crash should therefore be more limited and far less impactful as you approach retirement than many of the more risk-on approaches to investment that so many people are taking these days, such as putting everything in crypto or taking the market purist approach of investing only in the stock market. Both of these approaches are far riskier than many people realize at the moment, given such a long and strong run in US shares in particular. Remember, again, it only takes one big crash to erase many years of outperformance, as several million people experienced in the crypto market just in the last week or so. And it's really important to understand this and have a plan when you invest. So that's it for today. I'm sure you'll be relieved to hear. I hope you'll forgive my having covered our fund in some detail as one potential option when talking about defensive investments. But as I say, in an era where defensive investments are so particularly hard and where the chance of a big stock market crash looms large, we believe that it serves a purpose and it does what it says on the tin if used appropriately. And as ever, if you want to ensure that you're one of the first to see our future videos when they're published, please do click the subscribe and bell buttons. Do also please add any comments and or shout with any questions or suggestions for future topics. Please consider subscribing to our free email service from the Plain English Finance website. And if you'd like to hear from me more regularly, please do connect with me on any or indeed all of LinkedIn, Facebook or X. Until next time, I wish you and yours the very best.